Hello, I'm Mark Strosiak, Managing Partner with Infinium Investment Advisors. You have tuned in to our market update for February 2018. We are calling this Back to Reality. Yes, indeed, the go-go days of no risk and a ton of return we saw in 2017 are probably over. At least this was a warning shot to say, look, that type of environment just can't continue. So we're going to talk a little bit and try to help frame what's going on here, sort of in light of this sell-off. As a reminder, anything we talk about today is purely for informational purposes. It's not designed to be a recommendation to you. We don't provide tax and legal advice, and always consult your own financial advisor before making any investment decisions. So this guy here, as the markets go crazy, doesn't look too crazy, right? But obviously this is something that we've got to put it into context. We don't want to make rash decisions, and frankly, we're not really seeing that amongst our 100 or so clients. So that's really encouraging from where we sit. But we got to frame this, right? So January came raging out of the blocks, one of the best starts to the markets ever, really since 1997. And I think we put in somewhere north of 6% in the plus column there, in the win column. So giving back some in this sell-off that we've seen, not surprising. Year to date, depending on when you look at things here, less than 1% loss. So if I wound the clocks back to January 1st and I said, hey, in the 5th week of the year, we're going to be down a little less than 1%. Is that really going to concern you? Of course not. But of course, the press and the way they position it to us, they want us to sort of believe that this is a bigger deal than what it is. And we'll show that here in a second. So underlying all this is really strong momentum across the board. Low unemployment, tax breaks. Folks are positive. They're out there spending money. Recall that the U.S. economy, at least, is 70% consumer spending. So you and me, going on vacation, going to the mall, buying things from Amazon, whatever it is, spending money. And if we're fully employed, we're making our mortgage payments and we're out there spending. So we would tell you that these sort of underlying positive economic things that the stock market is built on are still intact. Unlikely that that's derailed by these losses that we've seen here in the last week. And our view too is that volatility needs to pick back up. In 2017, you had a quarter of the normal volatility, something on that range, and you had 20% returns. Well, folks, that's abnormal. Normally you don't get 20% return by taking no risk. So that sort of Goldilocks, fantasy land type environment, this might be a sign that that's sort of coming to an end or it's changing. And in our view, that's just normal. So you've got to be realistic in terms of what the stock market gives you and what you have to put up with in order to get those types of returns. So let's again get away from the what the press, or what's the financial press doing here? Well, they're going to focus on the point loss, right? Because that's number one on the list. This is for the Dow. So it ranks number one. Any of the articles that you'll see or you hear talked about on the news, they're going to talk the point loss because it's number one. But in terms of the percentage loss, which we'll look at in the next slide, hardly ranks. But this is what they want to focus on, and they want to make this a bigger deal than what it is. So arithmetically, if I just add up the two losses we saw on the 2nd and the 5th here, around 7%, 6%. So the markets in January were up north of 6, so we're kind of back to even. Just not something that we think indicates that you should make changes to a portfolio or be overly concerned. So let's look at the percentage loss, right? So this is the real number. This is the one that if they're reporting this, big deal. February 5th, that's a sizable loss in a day, 4.6%. But my goodness, doesn't even crack the top 100. And the loss on February 2nd to sort of kick this off, the devil sell-off there, 666, ranks number 539 on the list of biggest losses, one-day losses, 2.5%. It's just not something to be overly concerned with yet. we always want to have that caveat that this could be, a prelude to something larger. It always can be, and we want to stay vigilant of that. But in and of itself, this is not something that the sell-off, not something that we want to be overly concerned with, make rash decisions. So we just have some final thoughts. As I mentioned, the press hates boring bull markets that just grind higher. These guys have nothing to talk about. Big deal, the market's up and up and up. But when things sell off and you see this large point loss, that's news, man, and they're going to sell it to you. It's good for their business, but don't get caught up in it. Do not get caught up in it. It's going to provoke you to potentially do some things that are not in your best interest. So don't get caught up in that. So a few questions for you. We want to step back and ask ourselves here: do we need to catch every twist and turn of the markets? If you don't like this loss now, were you sitting on the sidelines at the beginning of the year because things were overvalued? You missed the 6%, and now you just sort of gave it back. And that stinks. But do you really need that to be successful? Most people, no. Answer to that is no. So don't worry about it. I think that can cause us a lot more stress than what we need. So in these types of highly volatile, unpredictable scenarios, you'd really have to step back from that. So normal volatility probably means more 1,000-point swings. So the press is going to love it. They're going to eat this up, and they're going to try to get to us, keep us interested. But in our view, this is normal based on where markets are at. On a percentage swing basis, 3-4%, yes. In one day, that's quite a bit, but it's not way out of the norm to say, gosh, we need to change something in our strategy. So you got to ask yourselves, can I handle this? Can I handle normal volatility? Because we just haven't seen it. And so this is something to ask yourself, are you willing to take these ups and downs to get the returns of the market? And if you're not, then make some changes. Get more conservative. And that's okay. Realize that if things really bounce back, you're not gonna participate in that. So it's finding that balance, right? So on average, things move up 7 or 8% a year. We had a 20%er last year. Now, and with hardly any volatility, now, what do you expect? Has this skewed you in terms of what you're expecting for that up and down? And we would say, look, if your expectations are unrealistic, get them realistic as soon as possible. 7 to 8%, 4 times the volatility of last year. That's kind of what we're looking at. So maybe it's time to reset sort of what we think and what we are trying to achieve here. And then finally, we always want to wind it back to your financial plan, right? Doesn't matter, whatever the market does, Whatever your neighbor does, and the taxi driver and Lyft driver, Uber driver, whatever. But this really comes down to, what do you need to be successful? What do you need to put the kids through school, retire when you want to, live the lifestyle you want to, get the dream home, second home vacation, whatever. But you gotta always put that in context. And if you're getting close to that number on either side of it, you're in good shape. So certainly financial plans that we review now generally are going to look really good because we had such a great year last year. But it always makes sense from our perspective to keep that at the fore, because that will help ground you in terms of what do you do at any given time. And does a drop like what we've seen really hurt you? Or these up markets, how much do they really help you? So you got to always keep that in mind. With that, I'm Mark Starosiak. Thanks for tuning in, and we'll see you soon.